Okay, let's jump right into this explainer on the true underlying mechanics of real estate syndications. Today, we're completely stripping away all that marketing fill you usually hear. Instead, we're going straight under the hood to look strictly at the structural, economic, and tax engines that actually drive these complex financial machines. We'll be zeroing in on the non-obvious cause and effect details you absolutely need to know to understand this at an expert level. Now, here is our roadmap to logically deconstruct this entire asset class today. We'll kick things off with the syndication engine, then break down the anatomy of a deal, dive deep into strategic tax optimization, uncover the sometimes harsh implicit reality of the passive loss constraint, and finally, wrap up with access and qualifications. All right, let's get into part one, the syndication engine and how capital is actually pooled. So at their absolute core, syndications inherently solve a massive scale problem. They basically allow investors to leverage their combined buying power to acquire cost-prohibitive institutional-grade assets. We're talking massive apartment complexes or huge commercial facilities that the average person could literally never afford, let alone manage by themselves. By pooling your resources, you're suddenly unlocking access to those institutional-level returns. It's like teaming up to buy the whole pie instead of just settling for a tiny crumb.
Now, this whole model fundamentally relies on a really strict division of labor. You've got the syndicator or the sponsor who acts as the active operator. They're the ones out there finding the deal and grinding through the daily management. Then you have limited partner, whose only job is to simply fuel the machine with capital. Yes, as a limited partner, you explicitly forfeit direct operational control, but the trade-off is that you generate passive wealth and entirely reclaim your time. It is a direct, calculated exchange of control for leverage and freedom.
And when we look at the expert analysis, it reveals that this asset class functions as a centuries-old inflation hedge. And honestly, that's not by accident. It's rooted in a very concrete reality. The physical supply of real estate is perpetually limited, while the human demand for shelter is totally non-optional. I mean, no matter what the broader economy is doing, people absolutely must have a place to live, right? This inelastic demand builds a highly durable foundation for preserving and growing capital over the long haul. Moving right along to part two, let's look at the anatomy of a deal, specifically the financial life cycle. Financial models point to a very strict four-step chronological life cycle here. First up is identifying the asset and securing the debt and equity to build the capital stack. Second, and this is absolutely crucial, is forcing appreciation. Sponsors don't just sit around crossing their fingers hoping the market goes up organically. They execute strategic physical property improvements to actively force the property's value higher. Third, they distribute the annual cash flow generated from those increased rents. And fourth is the capital event, where the asset is finally liquidated or refinanced, returning that multiplied capital back to the investors. Okay, let's ground this with a concrete case study to see how this wealth generation actually plays out. Imagine a $30 million 200-unit acquisition. The sponsor goes out and secures a $20 million commercial bank loan. To cover that remaining $10 million, they pool equity from limited partners, let's say 100 investors throwing in $100,000 each. This perfectly demonstrates the math of fractional ownership. It allows an individual to participate in a massive $30 million asset for just a tiny fraction of the total cost. Now, fast forward through a 5-year hold. During that time, those investors might be pulling in, say, 7 to 8% in annual cash flow. Finally, the sponsor sells the property for $42 million. After they pay off that initial $20 million loan, roughly $22 million remains. So, mathematically, that initial $100K investment transforms into a $180,000 return. It's just a striking real-world example of how the equity multiple and leverage appreciation actually work under the hood to severely accelerate wealth creation. All right, part 3. This is a big one. Strategic tax optimization, or how we actively shield that yield.
You might logically be wondering at this point, hey, if I'm generating all this extra income, how do I avoid massive tax burdens that just decimate my returns? Well, the answer lies in the strict application of highly specialized IRS tax code provisions that are specifically designed to incentivize housing development. The exact mechanism sponsors use for this is a highly detailed engineering study called cost segregation. Here's how it works. Instead of depreciating an entire building slowly over 27.5 years, engineers come in and physically isolate specific components with shorter lifespans. We're talking things like flooring, appliances, or fixtures. Doing this triggers massive bonus depreciation right in year one. It essentially creates this phantom non-cash expense that can effectively zero out the actual cash flow on your tax return. So you're getting real cash deposited into your bank account, but on paper, the IRS just sees a loss. It's incredibly powerful. The true power of this engine lies in the strategic stacking of these tax mechanics. First, you have that accelerated depreciation wiping out your rental income. Then, the mortgage interest acts as a secondary deductible tax shield. And finally, upon the ultimate sale of the asset, your profits are capped at the long-term capital gains rate of 20%. Compare that to a top ordinary income bracket of 37%, and you can clearly see why this is such a highly optimized system. It's quite literally designed to keep more of your money working for you rather than losing it to taxes.
Now, let's pivot to part 4. The passive loss constraint. This is the implicit reality check.
So here is the regulatory catch that trips up a lot of people. By default, as a limited partner, the IRS strictly classifies your investment as passive. What does that actually mean? It means those massive paper losses you generated from depreciation are locked inside a silo. They can strictly only offset other passive income. They absolutely cannot be used to shield your active W-2 wages or your 1099 business income. Well, barring one highly specific, very rigorous exception.
To actually unlock those massive write-offs and apply them against your active high-earning income, you or your spouse must log a minimum of 750 hours annually in real property trades. On top of that, you have to ensure that more than half of your total working hours for the entire year are strictly dedicated to real estate. It's an incredibly high bar set by the IRS to ensure only heavily involved professionals get this active tax benefit. And this brings us to the ultimate tax strategy for high earners: securing real estate professional status, or REPS. Doing this requires meticulous, bulletproof documentation of your material participation. It is absolutely a heavy compliance hurdle, no doubt about it, but it's an entirely necessary mechanism if your ultimate goal is to drop down tax brackets and utilize real estate as a true, active tax shelter against your primary income source. Finally, let's look at Part 5, access and qualifications, and the systemic barriers involved. The reality is the Securities and Exchange Commission essentially gatekeeps this entire asset class. In an effort to protect the general public from complex and illiquid investments, the SEC mandates that most of these syndications are restricted exclusively to what they call accredited investors. To hit that status, you must strictly meet specific criteria: either a minimum $200,000 annual individual income, a $300,000 joint income for the past 2 years, or possess a net worth exceeding $1 million. And that strictly excludes the value of your primary residence, which reveals a pretty stark implicit reality about access. While the economic scaling and the tax shielding benefits we've talked about are mathematically profound, the system itself is not exactly democratic. The sheer regulatory cost and legal liability for sponsors to accept non-accredited investors means that those opportunities are exceedingly rare. For the most part, the general public is legally locked out of these institutional wealth-building engines. You basically have to build significant capital first just to get an invitation to the table. So as we wrap up this explainer, I want you to deeply consider this fundamental equation. Real estate syndications are not magic. They are a highly structured exchange. You are explicitly trading away your personal liquidity and your direct operational control. But in return, you're unlocking institutional-grade scale, totally passive yield, and incredibly strategic tax shielding. So the ultimate question I'll leave you with is this:
does that specific mechanical trade-off actually fit into your long-term wealth strategy?